All right, we've been talking about it all week long, the deadline for taxes. The deadline to file 5 days away. And after a week of last-minute tax tips and advice to simplify and smooth what is a stressful process, we're concluding our user's guide to taxes with ways to get a jump start on next year's tax season. Let's get ahead of things. Here to help with that is the tax columnist for the Wall Street Journal, Thomas Herman. Tom, welcome to the show. It is great to have you here. Can we just talk about simple things to start with? Because you need a system, right? I mean, if you found yourself slammed against the deadline this year, you got to set stuff aside ahead of time. The receipts, organize them, get the information together. What do you recommend?
That's exactly right, Jerry. The biggest mistake people make is not doing something until the last minute. That way they miss out on a lot of very valuable deductions, credits, and other forms of breaks. For example, a lot of people could cut their capital gains taxes. A lot of people could take a look at their portfolio. If you've got gains, think about selling some of your losers that you've owned more than a year. You can offset the gains and the losses. Also, if your losses are even bigger than your gains, and that can happen in a lot of cases, you can deduct up to $3,000 a year, in most cases, off of your ordinary income. That's your wages. And if you have additional losses, you can carry them over into future years. But you've got to do that during the year. You can't do it now for 2014. All
right. Well, that's very smart. So let's talk about, you can do that. You also need to check your withholding because, as we've seen this year, the favorite scam du jour is stealing people's refunds. Well, if you don't have a refund, there's nothing to steal. So let's line those two numbers up and make sure that you're not getting a big check from the government. You're actually not giving the government free money, a loan with no interest.
Exactly right, Jerry. The government doesn't pay interest typically on tax refunds. So most people get tax refunds. They think it's great because they get a check in the mail from the IRS, but there's no interest. So it does pay to take a fresh look at your withholding. And if you've got expensive credit card debt, consider cutting that withholding and paying down that credit card debt, which can be above 20%. That's a great idea for a lot of people. And most people get refunds. I think so far 3 out of 4 returns filed this year got refunds. The average was over $2,800. That's a lot of credit card debt that you could use to pay down.
And so you have a sneaky way for people to save some money on their taxes. Let's say you live in Augusta, Georgia this week. You left. You're going to rent your house out for the Masters. You can actually make some dough on that and not pay taxes. How so?
That's right, Jerry. A lot of people don't know that. If you rent out your home, typically the rental income you get is taxable. But it's not taxable at all if you rent out your home for 14 days or less. I found out about this when President Clinton proposed eliminating this back in the 90s. There was immediate reaction from places like Augusta, Georgia, where this is done a lot during the Masters. And it's also very popular in the Hamptons. It's popular out here in La Jolla. It's called the 14-day rule. So if you're thinking of renting out your home, consider doing it for 14 days or less. All that rental income typically is tax-free.
All right, you say time your deductions. What do you mean?
At the end of the year, you can time your deductions, and in many cases, your income too, Jerry. For instance, if you're going to take the standard deduction for this year, consider postponing your deductions until next year when you'll be able to take them if you're going to itemize. If you take the standard deduction, as most people do, you can't itemize and you can't deduct any charitable gifts. So save them. Try and bunch them into the year where you'll get the biggest bang for the buck. Similarly, if you're near the end of the year and you can time bills if you're self-employed, you could send out a bill instead of December 31st, you could wait until the following year. Instead of doing it at the end of the year, do it early the next year, and you can save money that way too. Timing of income and deductions can be a great way to cut taxes.
It's pretty darn tricky, but you also say save your sales tax receipts. I just ran into this week. That's something we didn't think about, but what do you tell people?
It sounds like a real pain to save your sales tax receipts, but a lot of people would benefit by doing it. The reason is this. Congress is probably going to extend a law that expired at the end of last year. That gives you the option to deduct either your state and local sales taxes or your state and local income taxes. Now, if you live in outrageously high tax places, such as New York City or California, you're probably going to go with your income taxes. But if you live in a state with no income tax, such as Florida or Texas, and there are others, then you want to deduct your sales tax receipts if you itemize. So that can be a great way to trim your taxes if you itemize. Save those sales tax receipts. The IRS does give you a way to figure out if you didn't, but you will come out much better in most cases if you've saved those receipts, even though it's a huge pain.
It is a huge pain, but you're getting us ready for next year. Tom, I knew you'd be great on this. Thanks for coming on the show.
My pleasure, Jerry. Good to be with you again.